Welcome back. Central bankers have been active every weekend doing actually investment bankers' jobs. The Swiss Central Bank, SNB, worked over the weekend to get UBS to agree to take over crisis-hit rival Credit Suisse for $3.2 billion, the SNB pledging up to $108 billion in liquidity assistance. Last weekend, the US regulators similarly went into investment banking mode to rescue SVB and Signature Bank. But neither the US markets, nor the European markets, nor the global financial markets are convinced of near-term stability in the banking system or in the financial markets. What kind of market moves should we be prepared for here in India? I have with me Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking Products at Axis Bank, and Srinivasan Vardarajan, a former doyen of fixed income markets, now non-executive chairman of Union Bank. Gentlemen, thank you very much for joining me, and at short notice. I know it is such a moving terrain. Neeraj, first up to you. Just what does this look like? Where are we in the crisis? Is it that Bear Stearns is over, but the market thinks that something like Lehman can happen? Or do you think this time central bankers are way more proactive and therefore we may not have cataclysmic problems?
So I wish I had the answers to that question, Lata. We continue to debate whether it's the early part of the financial crisis or, this time around it could be different. I'm seriously hoping this time around it could be different because clearly there is a lot of learnings that have been taken from the global financial crisis, and the alacrity and the decisiveness with which the central banks and the policy makers and the regulators are moving in West in terms of solving the problem spots, whether it is SVB or whether it's Credit Suisse, not only just making sure that these institutions are addressed, but also the fact that they're providing liquidity to the market, whether it is Fed discount window, the BTFP program, and the fact that SNB has been quite generous in terms of its liquidity provision to UBS. I think all of these factors are pointing towards that regulators are very, very proactive at this point in time. There is a playbook that goes back to what was done at the time of GFC in 2008. And that playbook is being brought forward quite proactively. So I'm hoping that this does not convert itself into a bigger contagion, but fingers are crossed at this point in time. I think every day is a new day in this story.
Okay. Well, there was an El Arian tweet saying that UBS bonds and stocks may well come under pressure if the public sector support is limited to that $100 billion liquidity facility. So there are people who are not quite sure that this is sufficient. Srini, from your perch, which is away from at least dealing rooms, what is the sense you are getting? If the Fed were to not sound too hawkish, will that buy some near-term peace?
Yeah, Lata, this is, if you just dial back and see, this whole thing is because of the tightening cycle. I think all of us knew that easy liquidity, which was there for the last, so many years, when it was going to get withdrawn, is going to pose problems. And at the pace at which it happened over the last few quarters, I think this is something which is impacting almost every balance sheet, whether it is banks, whether it's central banks, whether it is corporates, whether it's intermediaries. So I think this is a problem which everyone is coping, right up to a retail borrower to some degree or the other. So to that extent, I think providing these backstops is useful, but staying where we are, I think in terms of rates, in terms of trying to sort of take a breather and allow things to sort of consolidate, stabilize, and then do what is needed is possibly the need of the hour. And that is what I think the central banks are trying to do, trying to provide the liquidity backstops, trying to make sure that things don't worsen from here. As each of the stakeholders, including banks and whatever type of banks they are, need to sort of assess what's the best way forward. And the central banks for that time need to provide these backstops. And I think that's where we are right now. I think reassess and see how to move forward, because this is not just limited to one participant. I think every bank, the largest bank in the world to the smallest bank in the world, or to even the smallest retail borrower, I think has felt the impact of higher rates and the pace at which it has gone up. And we need to reassess, stabilize things, consolidate, and then move forward and in the best possible manner.
Okay. Well, we have to come to the to what may come from the US FOMC. So, Neeraj, the market is, of course, now 2/3 voting for a 0.25%, and about 75% saying that that will be the last hike. Do you think? I mean, what would your best case expectation from the Fed be?
I think the biggest challenge for Fed is that they're coming into this crisis with very elevated level of inflation, unlike in 2008 when the inflation was not a problem. So that complicates the matter. It becomes a three-way balancing act. You know, on the one hand, you have inflation, you have growth, and then you have financial sector stability. I think it depends upon how the markets react between, and it could be as short-term as this, but how the markets react between now and the day of the FOMC. If we see the financial markets settle down, stabilize, and we don't see further problem, erupting, it's highly likely that Fed will go for a 25 basis point hike, making sure that the inflation fighting campaign that they are on, those sort of communications are not diluted. But the market has, predominantly rewritten the expectations around the terminal Fed funds rate. We are now almost 70 basis points lower than where we were about a week back. The terminal Fed fund rate, as per the Fed futures market, I think is close to 5%, 475 to 5%. And more importantly, the market is now anticipating 3 rate cuts or 75 basis point cumulative rate cuts going into the end of this calendar year by December 2023. So that's a significant repricing of where market sees the Fed going over the next 12 months. But it's still highly volatile. I think we'll have to see how this particular FOMC goes to assess whether that expectation of the market stands good.
Raghuram Rajan spoke to us last week, and he made the point that, he said he was expecting only a 25 basis, but he also said this uncertainty and fear of collapse has already created credit tightness. People are scared to lend. So the Fed's rate hikes job has partly been done by uncertainty and chaos. So, would it really hurt if the Fed just passed up the rate hike opportunity and just said that it wants the banks to catch their breath or something like that? You think that kind of an outcome is a possibility?
Well, 2 points here. One is that there is some commentary out there which says that the current events have actually been effectively equivalent to 1.5% increase in the Fed funds rate. This is one of the analysis. The second comment that I have is that if we go by what happened in UK at the time of pension fund crisis, I think UK Bank of England took a breather and allowed the market to settle down, and then started hiking rates once again once things were settled down. So whether Fed will go by the Bank of England playbook of taking a pause and waiting for the financial market stability to sort of settle down, financial markets to settle down, and then coming back to its inflation campaign remains to be seen. The big challenge for Fed is that current inflation rate of 6% is very far off from their target. So whether they can continue to keep their foot off the brakes, I don't think it's going to be very easy for them. So like I said, it's now a three-way balancing game.
Oh, yes, a trilemma, as Dr. Y.V. Reddy once called it. Central bankers don't have a dilemma, but a trilemma. Srini, there's one oft-asked question. Why is only SVB facing or faced a ALM mismatch or a write-down of securities? What kind of a problem should we expect in India? After all, we have also gorged a lot of government paper. Both FY21 and FY22, even FY23, are years of huge government treasury issuances at rock bottom yields, 4% and 5%. Should we have a problem here?
Not really, right? Because I think the way banks classify the investment portfolio is very different from how possibly SVB had. So if you look at what banks do here today, I think almost 90% of the investment portfolio is HTM. And therefore, the mark-to-market impact of that is not seen by either in the accounting or by the market. So to that extent, I think, and there is a mandatory SLR portfolio which banks have to hold, which is not there to some extent in most developed markets. So I think the case is different here. You can argue that even in SVB's case, I think the mark-to-market came to roost only when the rush for depositors to take out money happened, and they had to liquidate the thing. Otherwise, the mark-to-market is a mark-to-market. So my thing is that I don't think so we can strictly, the impact on portfolios on rising rates is there, as I said, right from the retail borrower to the largest bank. I don't think so we can run away from it. But how exactly it is perceived and how exactly depositors sort of react is going to be very different. And in India, I think, I don't think so there's anything which we saw in SVB which will sort of happen here, right? I think we are in safe zone as far as the investment portfolio is concerned. And on the whole, I would still think this contagion is not going to impact us, but overall tightness, liquidity across the world, then risk off, and then what it means for global growth, and then what it means for Indian economy, and then what are the ripple effects on account of that, I think is more important than just the SVB contagion.
Okay, so the global headwinds in terms of slowdown and risk off is what we should worry about. Point taken. Neeraj, exactly that. What is your best guess of how the financial economic situation is going to look like over the next 12 months? Will we be having inflation and stagnation, basically stagflation?
So before I comment on that, my take on the question that you asked, Srini, I think we need to be very mindful of that. One is that in case of SVB, the unrealized mark-to-market losses on their HTM portfolio were actually equal to or slightly higher than their equity capital, right? There is some data out for Indian banks. If you look at the RBI's financial stability report, the unrealized mark-to-market losses in case of Indian banks, my estimate is roughly about 5% of the combined equity capital of the banking system. So we are in a very, very different situation as far as that particular element is concerned in the Indian banking industry. I think the one key thing in our case is that while, yes, of course, we have SLR-driven securities holdings in our HTM portfolios, but it is also limited to about 23% of our NDTL. So that puts a cap on how much banks can carry in the HTM. Now, to your other question on what is the implication, I think I concur with what Srini said, that there is a sentiment effect that we need to be mindful of. We need to understand how this kind of, sentiment point of view, this kind of goes from one market to the other and becomes a global situation. At this point in time, I think it feels like that markets in India are quite calm, whether it's equity or whether it's fixed income. I think bond yields in India are at very, very range bound, somewhere between 730 to 745. We are having reasonable amount of liquidity, and Reserve Bank continues to provide liquidity by way of VRRs. It is March, and so their markets are sort of seasonally tight from a funding perspective, but I think central bank is reasonably active in terms of giving liquidity. So at this point in time, I don't see too much of fall off, but we need to be very, very mindful of how the sentiment kind of swings around and whether it has an impact.
Okay. Well, I think we need some economists to tell us whether we can, expect a fairly deep gash in our growth, but that discussion for another day. Out of time, Srini and Neeraj, thank you very much indeed for joining me. The big takeaway is that we shouldn't worry so much about the health of the Indian banking system. The bigger worry for us is possible global recession, possible global stagflation. That could mean lower orders for IT companies. Already the startup scene is not creating any jobs, is likely creating job losses. We could see some ripple effects in the IT sector, and we could see a fairly important impact, a fairly serious impact on our export sector as well. So growth could be a casualty. With that, we'll wrap up on Bazaar. We'll get back to trading ideas on Chartbusters.